$6 million. That's what DeepSeek claimed it cost to train a model that matched GPT-4. OpenAI spent closer to $100 million. 1 year later, China hasn't slowed down. It's accelerating. Welcome to Asia Tech Macro. I'm Alex.
And I'm Maya. Today, we're taking a hard look at where China's AI wave actually stands in early 2026, 1 year after the DeepSeek shock. Because I was reading a CNBC piece just this morning, and honestly, the story has moved way beyond DeepSeek itself. There's MiniMax, Moonshot, Alibaba's QN, ByteDance's C-Dance. China has launched at least 5 major new models in the past 6 weeks alone.
Right. And the one that's caught the most serious analyst attention right now is MiniMax. The company went public in Hong Kong in January 2026, and in mid-February released its M2.5 model. According to UBS analysts, MiniMax's AI usage has already reached 1/3 of Anthropic's Claude, at 1/10 the price. UBS initiated coverage with a buy rating and a price target of 1,000 Hong Kong dollars, implying over 30% upside from current levels.
1/10 the price. That number is almost hard to believe when you say it out loud.
It is. And it's not just MiniMax. DeepSeek itself is preparing to release its next-generation V4 model, reportedly trained on NVIDIA's most advanced available chips as soon as this month, March 2026. Early indications suggest it could outperform current models from both Anthropic and OpenAI on coding benchmarks. And the broader market data is striking. DeepSeek currently holds 4% of global chatbot market share, with ChatGPT at 68% and Gemini at 18%, according to SimilarWeb. The gap is still large, but the trajectory matters.
And the geographic story is fascinating. Microsoft's own Global AI Adoption Report noted that DeepSeek usage in Africa is running 2 to 4 times higher than in other regions. China's open-source, low-cost strategy is winning in exactly the markets where U.S. companies have historically underinvested.
Which sets up everything we're going to discuss today. Because the real question isn't whether Chinese AI models are technically impressive. They clearly are. The question is, what does this mean for enterprise adoption, for U.S. hyperscaler revenue in Asia, and for the geopolitical AI race? That's where it gets genuinely complicated. Stay with us. Okay, segment 2. Let's get past the benchmark headlines and into the enterprise reality, because there's a significant gap between impressive model release and companies actually deploying this in production. Maya, you've been talking to founders in Southeast Asia. What are you actually hearing?
So the honest picture is more nuanced than either the bull or bear case suggests. In consumer applications, chatbots, content generation, coding assistants, Chinese models are gaining real traction, especially in markets where OpenAI has limited local presence. Vietnam, Indonesia, Thailand, the Philippines, the price point is simply unbeatable for early-stage startups with thin margins.
But enterprise is a different story.
Completely different. I was just talking to a fintech founder in Singapore last week, and he said something that stuck with me. We want to use DeepSeek, but our compliance team won't sign off. And that's the pattern you hear repeatedly. Data residency concerns, regulatory uncertainty around Chinese origin technology, and for any company with U.S. investors or U.S. customers, the reputational risk of being seen as dependent on Chinese AI infrastructure. Those frictions are real, and they don't show up in benchmark comparisons.
And there's a harder structural problem underneath that. The U.S. export controls on advanced chips to China are still in place and tightening. DeepSeek's efficiency gains are genuinely impressive, but they're partly a response to constraint, not just innovation. Bernstein analyst Mark Lee noted in a February 2026 research note that Chinese AI labs are operating with roughly 40% less compute per model than their U.S. counterparts. They've compensated through algorithmic efficiency, but at some point, hardware constraints become a ceiling on capability growth.
Okay, devil's advocate though. Isn't that ceiling argument something people have been making since 2022 and Chinese companies keep beating expectations anyway?
Fair point. And that's exactly the tension. Every 6 months, the consensus says China has hit the wall, and every 6 months, a new model release proves the consensus wrong, which suggests either the chip controls are less effective than Washington believes, or Chinese engineers are genuinely better at efficiency optimization than anyone expected. Probably both.
Which brings us to segment 3, the ripple effect. Because the U.S. hyperscalers have massive revenue exposure to Asia, and Chinese AI is directly competing for that growth. Microsoft Azure, Google Cloud, Amazon Web Services, all 3 have been aggressively expanding Asia data center capacity, betting on AI-driven cloud demand. But if enterprises in Southeast Asia and South Asia choose Chinese models running on domestic infrastructure, the growth assumptions baked into those hyperscaler valuations start to look shaky.
The numbers are significant. Asia-Pacific represents approximately 18% of total hyperscaler cloud revenue today, but it accounts for nearly 30% of projected growth through 2028, according to Gartner. If China's open-source ecosystem captures even 20% of that incremental demand, you're talking about several billion dollars of revenue that doesn't flow to AWS, Azure, or Google. That's not existential, but it's material enough to matter in earnings calls.
And the Japan angle is interesting here too. Japanese enterprises have been among the most cautious adopters of Chinese AI for obvious geopolitical reasons. But smaller Japanese firms, particularly in manufacturing and logistics, are starting to quietly pilot DeepSeek-based tools because the price difference is simply too large to ignore. Nikkei Asia reported in February that at least 3 major Japanese trading companies are running internal evaluations of Chinese models alongside U.S. alternatives.
Which sets up a fascinating strategic question for Part 3. Because I want to challenge the assumption that U.S. AI dominance is as durable as the market currently believes. Don't go anywhere.
All right, contrarian corner. And my uncomfortable view today is this. The market is pricing U.S. AI dominance as a 10-year structural advantage. I think it's a 3-year window, maximum. And the mechanism that closes it isn't geopolitics, it's commoditization.
That's a bold claim. Walk me through it.
Sure. The consensus narrative is that OpenAI, Anthropic, and Google have an insurmountable lead because of their data, their talent, and their compute. And in 2024, that was largely true. But here's what's changed. The open source movement, led by Meta's Llama releases and now aggressively extended by Chinese labs, is systematically democratizing the capability layer. Every time Meta releases a new Llama model, it compresses the performance gap between frontier closed models and what anyone can run for free. DeepSeek accelerated that compression dramatically, and MiniMax's pricing, 1/10 of U.S. alternatives, suggests the monetization premium for U.S. models is already eroding faster than consensus expects.
But isn't there a quality ceiling to the commoditization argument? Like for the most demanding enterprise use cases, legal reasoning, complex financial modeling, medical diagnosis, frontier U.S. models still have a meaningful edge. The gap isn't zero.
It isn't zero today, but look at the trajectory. 18 months ago, the gap was described as enormous and unbridgeable. Today, analysts are saying meaningful. In another 18 months, what word do they use? The direction of travel is clear, even if the destination timeline is uncertain. And here's the investment implication that I think is being missed. If AI model capability commoditizes, the value shifts entirely to the application layer and the distribution layer. The companies that win aren't the ones with the best model. They're the ones with the best data moat, the best customer relationships, and the deepest vertical integration into specific industries.
That actually reframes the entire China AI story. Because Chinese companies, Alibaba with its e-commerce data, ByteDance with its content graph, Tencent with its social and payments data, potentially have stronger application layer moats than any pure-play AI lab. The model is just the engine. The data and distribution is the car.
Exactly. And Western investors are still valuing the space primarily on model benchmarks, which is the wrong scorecard if commoditization is the destination.
Okay, and here's the question I want our listeners to sit with. We've talked about enterprise friction, compute constraints, and commoditization risk. But here's what I keep coming back to. If you're a CTO at a mid-sized company in Southeast Asia right now, not a US-listed company, not a company with US regulatory exposure, just a regional business trying to compete, is there any rational argument for paying U.S. model prices when Chinese alternatives are functionally comparable at 1/10 the cost? And if the answer is no, what does mass adoption of Chinese AI across emerging Asia actually mean for the balance of technological power in this region over the next decade? That's the question that should be keeping U.S. policymakers up at night, not the benchmark scores.
That is exactly the right frame. And in Part 4, we're going to tell you what to actually do with it. Stay with us. All right, action items. 3 concrete things to do with everything we've discussed.
Number 1, add Chinese AI platform stocks to your watch list, but be selective about the entry point. MiniMax's Hong Kong IPO gave Western investors direct access to China's AI application layer for the first time at scale. Alibaba Cloud, which is embedding QN models across its entire enterprise product stack, is the larger liquid proxy. The key filter? Look for companies with proprietary data moats, not pure model developers, but platforms where AI enhances an existing distribution advantage. Those are the compounders. Pure-play model companies without distribution are the ones that get commoditized.
Number 2, reassess your hyperscaler Asia growth assumptions. If you own Microsoft, Google, or Amazon on a thesis that Asia-Pacific cloud growth drives the next leg of earnings expansion, you need to stress test that assumption against a scenario where Chinese AI captures 20 to 25% of incremental Southeast Asian and South Asian enterprise demand. That's not a catastrophic outcome for those stocks, but it's a meaningful revision to growth rates that consensus hasn't fully priced in. Run the sensitivity analysis before the market does it for you.
Number 3, watch the U.S. export control policy calendar for Q2 2026. The Biden-era chip restrictions are currently under review by the new administration, and there are credible reports from Reuters and the Financial Times that a revised framework could be announced as early as April. Any loosening of restrictions on mid-tier chips, the kind China's AI labs actually need, would be a significant catalyst for Chinese AI stocks. Any tightening would be the opposite. This is a binary policy event with asymmetric market impact, and it's underappreciated as a near-term catalyst.
The takeaway for today: China's AI story in 2026 is no longer about one dramatic moment. It's about a sustained, systematic compression of the performance and price gap with U.S. models. The enterprise adoption friction is real, but eroding. The commoditization of model capability is accelerating. And the emerging market battleground, Southeast Asia, South Asia, Africa, is where the next decade of AI market share gets decided, mostly out of sight of Western investors. The companies that understand this geography win. The ones still benchmarking on U.S. enterprise metrics alone miss it entirely.
And the meta lesson, in technology, price always wins eventually. Always.
Next time on Asia Tech Macro, we're going to zoom out to the macro picture and look at currency dynamics across Asia. The yen, the Korean won, the Indonesian rupiah, all moving in ways that are creating both risk and opportunity for tech exporters and importers across the region. Plus, we'll look at what a stronger dollar environment means for the China Plus One supply chain story. That's next.
Really looking forward to that one. Lots to unpack.
Stay data-driven. Bye.